Have you ever wondered how a company can look like a superstar one day and be a total fraud the next? Well, today, we are pulling back the curtain on one of the most audacious tricks in the corporate playbook, faking revenue completely out of thin air. We're going to look at how some of the biggest names in business got caught cooking their books.
John Lennon famously asked us to imagine. And, that kind of creative thinking, that imagination, is what drives incredible innovation. But what happens when that same imagination gets twisted in the boardroom? Well, that's when some executives get dangerously creative with their accounting. They start to imagine a perfect world where sales targets are always met, even if the sales themselves are completely fake.
So, here's our roadmap for today. First, we're going to learn the actual playbook for faking revenue. Then we'll dive into 3 different case files, looking at real-world fraud. And finally, we're going to build your very own investor detective kit so you can spot these schemes for yourself. Let's get right into it.
Okay, Section 1, the art of fake revenue. We're about to unpack the 4 main techniques that are behind pretty much every revenue fraud scheme out there. Think of this as the criminal's playbook.
This is basically the secret recipe for cooking the books. You can invent a sale out of nothing, you can do a deal with yourself, you can try to disguise a loan as revenue, or you can just, inflate the value of a real sale. Pretty much every case we're going to look at uses some combination of these 4 moves.
All right, on to Section 2, phantom sales. This is our first case file. Here we're investigating transactions that look totally real on paper, but in reality, they're complete illusions. They have absolutely no real economic substance. Our first subject is the insurance giant AIG. Now, they invented this product they called finite insurance, and the sales pitch was just incredible. They offered to literally insure companies against the risk of missing their quarterly earnings targets. Sound a little too good to be true? Yeah, it was. So here's how it actually worked with one company, called Brightpoint. They were staring down the barrel of a $15 million earnings miss. So AIG sold them a retroactive insurance policy. But here's the catch. The policy covered a loss that had already happened. In reality, it was just a loop. Brightpoint was giving AIG money that AIG would then just give right back to them later. It wasn't insurance at all. It was a loan, plain and simple, designed to hide a loss.
The absurdity of the whole scheme is really simple. It's like this. You can't insure your house after it's already burned to the ground, right? The risk is gone. There's nothing left to insure.
And this all boils down to a fundamental accounting rule. For an insurance policy to be legit, there has to be a genuine transfer of risk. If there's no risk being transferred, it's not insurance. It's just a loan. And that is exactly why regulators came down hard on both AIG and Brightpoint.
Now, this whole phantom sale idea isn't just for insurance. Take a company called Peregrine Systems. They had this clever little name for their scheme. They called it parking transactions. What they would do is book these massive software sales to resellers right at the end of a quarter, but they had these secret side deals that meant the resellers never actually had to pay for any of it. The sales were totally non-binding.
And the scale of this was just staggering. When the fraud was finally uncovered, Peregrine had to reverse over $500 million in revenue they'd already reported. $509 million of sales that were just smoke and mirrors.
Then you've got the round-trip scheme, which was perfected by a company called Autonomy. What they did was they'd sell software to distributors, which created what looked like a perfectly legitimate sale. But then they would secretly use other companies to buy that exact same software right back. So money went out, and then the very same money came right back in, creating this perfect illusion of booming sales.
And this illusion was so convincing that it actually fooled Hewlett-Packard into buying Autonomy for over $11 billion. Just 1 year later, HP had to take a massive $8.8 billion write-down, and they had to publicly admit that they had been completely duped by Autonomy's bogus accounting.
Okay, on to Section 3, crooked deals. Our next case file digs into deals that are not at arm's length. This is what happens when a company starts manufacturing sales by, doing business with itself.
Take a look at Syntax Brilliant. They were a maker of high-def TVs, and they were posting this unbelievable growth. But when you looked a little closer, almost all of that growth was coming from huge sales to a single distributor in Asia, who also just happened to be one of their joint venture partners. A little suspicious, right?
Oh, yeah. And the red flags were waving everywhere for anyone who just read their public filings. I mean, nearly half of all your revenue is coming from one related party, and you're giving that customer incredibly generous payment terms that just keep getting extended. It all points to one thing. These were not real sales.
Eventually, the whole sham collapsed when Syntax Brilliant had to repurchase $100 million worth of TVs it supposedly already sold.
But trust me, it gets even more blatant than that. Take Hanergy Solar. They took this related party sale thing to a whole new extreme. Their number one customer was their own parent company. I mean, just look at these numbers. In 2013, 100% of Hanergy's reported revenue came from sales to itself. The parent company was just moving money from one of its pockets to the other and calling it revenue. And this sent its stock price soaring, right up until the whole thing inevitably imploded.
All right, Section 4, the numbers game. For our final case file, we're digging into pure accounting tricks. This is where companies don't necessarily invent sales from scratch, but instead, they misclassify money or inflate transactions to make themselves look much, much bigger than they really are.
One of the most common tricks is called grossing up. Imagine you're a broker. You help with $1 million deal, and for your work, you earn a $10,000 commission. Your actual revenue is that $10,000. That's the net. But what if you reported the full $1 million as your revenue? That's grossing up. It makes you look 100 times bigger than you are. This was a key shenanigan at both Enron and, more recently, Groupon.
And you can see the absolutely massive impact this had on Groupon. Right before its IPO, the SEC forced them to stop grossing up. And look what happened. The revenue for a 6-month period plunged from almost $1.6 billion down to just $688 million. That's a 57% drop, practically overnight.
So that brings us to Section 5, the Investor Detective Kit. After seeing all of these schemes, you've got to know what to look for. So let's assemble your toolkit. We'll go through the key red flags that can help you spot potential fraud before it completely blows up.
Here is your checklist. Are their accounts receivable growing way faster than their sales? That's a huge sign that customers aren't actually paying. You got to watch out for barter deals where no real cash is changing hands. Be extremely wary of significant sales to related parties, just like we saw with Syntax Brilliant and Hanergy. And you should always question any company, like Enron, that has this explosive revenue growth but somehow has razor-thin profit margins. These are the telltale signs of trouble.
So we've unpacked the playbook, we've exposed the schemes of the past, but that leaves us with one final and kind of provocative question. Now that you know all the tricks of the trade, which companies out there today might be using this exact same playbook to fool investors? Now that's something to think about.